Okay, Assalamualaikum and good afternoon. So for today, we are going to continue with the valuation of instruments. Okay, so for our previous meeting, we've discussed about bond valuation. Okay, so we have four types of valuation, which is we have the valuation of bond or the value of bond VB. We have the current yield. Then we also have yield to maturity and yield to call. Okay, so for today, we're going to continue with the other types of instruments, which is the stock valuation. Okay, so here we have two different types of stocks. First is called preferred, and the other one is common stocks. Okay, so first, obviously, we're going to discuss what would be the features for the respective types of stocks. And at the end of it, obviously, we're going to discuss how to actually value or calculate the stock's valuation. Okay. So first, we're going to look at the preferred stock. Okay. By definition, okay, preferred stock is a type of stock which possess a combination of features. Possessed by both equity and also debt instrument. So if you remember in our previous topic, debt instrument is actually referring to one of it is bond. Okay, so by definition again, when we talk about preferred stocks, it is actually considered as a hybrid instrument. So why it's called hybrid? Because it's possessed, like I said, they combine the features of bond and also the common stocks. Okay. Obviously, we haven't discussed the common stocks features yet, but later on, when we combine the information that we've learned in preferred and common stocks, you can see why we say that preferred stock is a hybrid instrument. Okay, so meaning some of the elements of bond possessed by the preferred stocks together with some characteristics of common stocks. Okay, so already mentioned earlier, the hybrid security, which possess the characteristics of both preferred and the common and also bonds. First characteristic that is quite important is the priority of claims. Okay, priority of claims. In terms of the sequence, the preferred stockholders will receive their claims before the common stockholders, but after the bondholders. So technically, it will look something like this. So first party that will receive, the claim would be the bondholders. Okay, second would be the preferred stock. Okay, one that we've discussed now. The preferred stockholders are the second one to receive, and the last one would be the common stockholders. Okay, so the common stockholders will be the last party to receive. So that's why I said here is ahead of common stocks. Okay, but technically they will be after the bondholders in terms of any claims, in terms of their income and also in terms of their assets. So if you remember when we talk about bond, the bondholders are expected to receive interest in the form of coupon. Okay, coupon interest. So the coupon interest will be received first. Okay, as a bondholders, they will receive their coupon quite early in the account. Okay. In fact, before the announcement of net profit of the company needs to pay the bond payment ataupun the coupon first to the bondholders. So once they announce the profits, okay, if they decided to pay dividends that year, so the preferred stockholders have the priority in terms of receiving the dividends. Okay, so for preferred stockholder, they will receive dividend. They will not receive interest, they will receive dividend. And lastly, if there's any leftovers, then the common stockholders will receive their dividends. Okay, so common stockholders will be the last one to receive. So when we list, or if we put in sequence like this, obviously we can associate this list with the risk factor. Okay, so whoever receive first obviously will have the least risk. Okay, the lowest risk among all. Okay, so whoever receive last would be the highest risk. Okay, so obviously if you compare the three, bondholders will have the lowest risk, whereas the common stockholders will have the highest risk because they're gonna receive it last. Okay, so preferred stocks being the middle will have a middle risk lah. Okay, so now we talk about the dividends. Okay, we talk about the dividends. If you remember bond, okay, they have a fixed coupon. Okay, so meaning as investor, if you invest in bond, the returns will be fixed. Okay, so this is one similarity of preferred stocks together with the bond, whereby the returns now in the form of dividends will be fixed amount. Okay, so for preferred stocks, share the fixed income status, similar like bond. Okay, so this is one similarity, okay, of characteristics between bond and also preferred stock, whereby the returns are fixed. So for preferred stocks holders, the returns, okay, in the form of dividend can be expressed either using a fixed dollar amount ataupun fixed ringgit amount, or it can be expressed in a percentage. Okay, in a percentage. And regardless either in the fixed dollar amount ataupun in percentage, we can find actually how much will be the return for every unit of bond, because even if it's in percentage, we can get it in ringgit by dividing, or we just multiply the percentage with the stock's par value. Okay, with the stock's par value. And again, if you remember in bond, the par value of bond is 1,000 ringgit. Okay, but for preferred stock, the par value is 100 ringgit. Okay, 100 ringgit each. So meaning if it's given in the form of percentage, what we need to do to get in dollar amount ataupun in ringgit amount, simply multiply the percentage with the 100 ringgit. So for example, if it's a 5% dividend, example. So in order to get it in ringgit, simply take 5%, multiply 1 ringgit, which is 5 ringgit. Okay. And this 5 ringgit will be fixed. Okay, it will be fixed. It will not change. Every year it will be the same for every 1 unit of preferred stocks. Okay, another similarity between bond and also preferred stock, whereby all preferred stocks needs to be rated just like bonds. Okay, remember we have RAM. We've discussed this before in bond valuation. We have rating agencies. Okay, for example, we have RAM, we have Mark. Okay, to name a few, S&P, Moody's. Okay, all of these are example of rating agencies, and they will rate the preferred stocks of the companies as well. Okay, so again, they will give high ratings for the good quality investment and low ratings to those consider non-investment grade. Okay, they will grade that accordingly. Next, similar like bond also, they have conversion features. Okay, we may not discuss in details the conversion features for bond. Yeah, some of the bonds, okay, we call them convertible bond, has features of conversion, meaning as a bondholders, you can convert your bond into common stocks. Okay, into common stocks. Similarly, for preferred stocks, they might have conversion features as well, which allows the preferred stockholders to convert the preferred stocks into common stocks as well. Okay, so when they convert, obviously they have pros and cons lah between the types of investment. Okay, if you compare between bond and common stocks, obviously you have difference. Similarly, for preferred stockholders and convert into common stocks, there's also pros and cons. Okay, as you all know, first you can see from this list. Okay, so meaning if you convert from preferred into common stocks, your ranking in terms of priority of claims will switch. Okay, so meaning instead of you receiving in the middle, you're going to receive it last in terms of your return. However, obviously, if you are the common stockholders, you are actually the owners of the company. Okay, so therefore, as the owner of the company, obviously you might have higher returns because bond and preferred stock, if you remember, are fixed returns. Okay, but for common stockholders, the returns are not fixed. So therefore, you might have higher returns if the companies perform well. Okay. What else? Okay, this one already mentioned. Seniority above the common stockholders. Okay, maybe I want to talk about the provisions, cumulative and non-cumulative provisions. Remember, when we talk about bond, their payment of coupon are mandatory, okay, are compulsory. So meaning, as a company, issue bond, you have to pay your coupon to the bondholders every year without fail. Okay, without fail, you have to pay every coupon payments. Okay, but for preferred stocks, okay, for the dividends, okay, for these dividends, and this dividend applies for both preferred and common stockholders, but we are talking about preferred now. Okay, for preferred stockholders, you're gonna pay them dividends, and the dividends, if you remember again, the dividends are fixed. Okay, but for dividend status, unlike coupon, dividends are not compulsory. Okay, dividends are not compulsory in terms of the payments. And here comes the provision. What kind of provision? Cumulative versus non-cumulative. So what does it mean? For cumulative provision, okay, for any unpaid dividends, meaning let's say this year, ataupun let's say last year lah, 2020, okay, the companies doesn't perform very well and they don't pay any dividend. Okay, both for preferred and common stockholders. Okay, for this year, 2021, for example, the companies perform better and have gained quite substantial amount of profits. And then they want to pay dividend this year. So meaning last year they tak bayar kan? They haven't paid last year dividend. But this year, since they perform well, the company, they want to pay dividend. So if it's cumulative provision, okay, if it is cumulative provision, so meaning any unpaid dividends, okay, must be paid. So meaning last year's punya preferred stockholders dividend together with this year's dividend, they have to pay it first before they can pay to the common stockholders. And again, if you remember, who are the common stockholders? These are the owners of the company. So meaning before we pay the owner, we have to pay the preferred stockholders first. Any unpaid dividend. Okay, any unpaid dividend. So example tadi maknanya last year's and this year's dividend they have to pay first before they pay for the common stockholders. Okay, if it's cumulative. Okay, but if it's non-cumulative provision, let's say last year dia tak bayar. Okay, so this year the company is excused. Okay, excused from paying any unpaid dividends. So meaning if they miss their payment last year, so if this year the companies perform well, they just need to pay this year's dividend, not any unpaid in the previous years. Okay, so as investor, you need to check whether the preferred stock that you pay is cumulative or non-cumulative. It depends on the company's issuance. Okay, so that's the difference lah between cumulative versus non-cumulative. Okay, so any unpaid dividends is called in arrears. Okay, this is common terms used for any unpaid any unpaid amount lah. It can be in terms of loans as well. So kalau you take a loan in the future, if you have number of months in arrears, it indicates that that's your unpaid installments. Okay. Okay, so this is another comparison. If you want to compare between bond, preferred, and common stocks. Okay, for voting rights, bond don't have voting rights. Okay, for preferred stockholders, they don't have voting rights as well. They do not have voting rights, but there's a exclusion lah. Okay, you might have a voting right if you are not paid by issuers in terms of the dividends. Okay, but in general, you don't have voting rights. Okay, But for common stockholders, the last one, yes, they have voting rights. So this is another comparison. If the question asks you to compare between bond, preferred, and common stockholders, first you can compare in the sense of the sequence, in this sequence, who gonna receive first in terms of priority of claims. Okay, second, you can compare against the voting rights. Okay, bond and preferred stocks, again, similar here. Don't have voting rights, but for common stockholders, yes, they have voting rights. Okay, what kind of voting rights? They can basically vote in major decisions of the company. So, in terms of what kind of decisions, it can be in the form of electing new board of directors, for example, involved in decision making with issuance of new stocks, for example. So a lot of key decision can be determined by the common stockholders. So that's why they have the voting rights. Because if you remember again, common stockholders are the owners of the company. Okay, so that's why they have the rights to vote. Okay, the rights to vote. So bond and preferred stocks holders are not considered as the owners of the company. Okay, so preemptive right. Okay, this preemptive right applicable for preferred and common stocks only. Okay, bond don't have preemptive rights. Okay, what kind of preemptive rights? Rights to subscribe to additional issuance of shares. So meaning, let's say I have stocks. Okay, it can be preferred or common stocks for company A now, and the company decided to issue new shares. Okay, so therefore, before they issue to the public, they're gonna offer to the current subscribers first. Okay, so that is what we call as preemptive rights. Okay, rights to purchase additional shares. Okay, ahead of a member of the public. So as a investor, you're gonna receive this rights ataupun chance to purchase additional shares first. And again, this is conditional. Okay, it is not a compulsory. So meaning when the company offers to you to subscribe to more shares, it is not compulsory. So you as investor, you can take up the rights or you can just ignore the offers. Okay, so that's preemptive. Next one, callable. This is again similar like bond. You remember one of the measurement of bond whereby we have YTC, yield to call. Okay, which is this part to call. Okay, so for preferred, they also have callable features whereby the issuer, whenever they have better financial background, okay, they can replace or redeem the preferred stocks. Okay, the preferred stocks. Okay, but the difference between callable features for bond and preferred, for bond, we know the bond has maturity. Okay, bond has maturity, but for preferred stockholders, they don't have maturities. Okay, the preferred stocks. So this callable usually will be specified in the contract. When is the callable features ataupun when will be the call period. Okay, so for preferred stocks, they are allowed to call within that specified period only. Okay, so later on you can read back the types of preferred stocks, the participative, some I already mentioned about the cumulative versus the non-cumulative. Okay, callable and also convertible. You can read by yourself here, right? In terms of advantages versus disadvantages, we have again to the investors and also to the issuers. From investors' point of view, the advantages would be the product ataupun the instrument is marketable. You can purchase it in Bursa Malaysia. Okay, the earnings are guaranteed because it is a fixed dividend. So therefore, as investor, you know your returns are fixed, okay, and somehow guaranteed. Your returns is slightly higher as compared to bondholders. Okay, slightly higher. Obviously, because you are actually facing higher risks as compared to bondholders, because bondholders, as I said earlier, the coupon are fixed and compulsory. Okay, but for dividend, it is fixed, but it's not compulsory. So therefore, you have some risk element there because there might be some years you don't have any dividend returns, especially if you are non-cumulative, because any unpaid, you're gonna miss the opportunity of returns. Okay. And last advantage here, it is considered less risky as compared to the common stockholders. Okay. However, in terms of disadvantages, yeah, you don't have voting rights. And since your returns are fixed, this is quite similar like bond. So even the companies perform very well that year, you're not going to have more returns because your return will be fixed to the specific amount. So even the company perform extremely well, you're not going to have higher returns. Okay. Next one. For the issuer, yeah, if you compare against coupon, dividends not mandatory as I mentioned before. So if you have low returns that year, you don't have to pay dividends. Okay, but just be careful if as issuer, if it's cumulative, then you still need to pay next year. Okay, and as I said tadi, preferred stockholders will not share the surplus earnings. So where this surplus earnings? This is from the net profit. Okay, so as a preferred stockholders, you will not enjoy okay additional returns even if the company has higher returns, as I said tadi lah. So this is related with this one. So it will be disadvantage to investor, but this will be advantage to the issuer because the returns will not be shared with the preferred stockholders. Okay, disadvantage for issuers, yeah, the cost is slightly expensive. There's no tax deductibility. For bond, yes, they have tax deductibility, but for preferred, the dividend payment are not tax deductible. Okay. So in terms of valuation, very simple. If you remember again, for bond, we have VB, valuation of bond. Okay, and the rest, okay, CY lah, YTM, YTC. But for preferred, we just focus on this one. Okay, maybe there's another one afterwards lah, but the intrinsic value measured using this formula, VP, okay, valuation of preferred, equals to D is annual dividend. Okay, this dividend payment must be in annual amounts. And if you remember again, the dividend can be expressed in two ways, either in ringgit or in percentage. So the D here you want is in ringgit. So meaning if the question give you in percentage, for example, you need to multiply the rate of dividend, okay, the percentage of dividend, multiply with the par value. You need to multiply with par value in order to get it in ringgit. And again, if you remember, the par value of preferred is value 100 ringgit. Okay, 100 ringgit. So if it's 5%, just like my first example earlier, 5% times 100 is 5 ringgit. So the dividend will be 5 ringgit. Okay, and we divide with the K. K is required rate of return. Okay, required rate of return. Sometimes they use the word yield. Okay. So this is one example. Okay, Syarikat ABC issued a preferred stocks with a par value of 100 ringgit and the dividend rate is 10%. Okay, and if Rizwan's required rate of return is 12%, so this is okay, what would be the price he willing to purchase it? Okay, or in other words, what would be the VP, valuation of the preferred stocks, or what would be the intrinsic value? Next, is it advisable to buy if the market price is 90 ringgit? So there are only two things we need. The dividend, which is the 10% per annum, and the K, the required rate of return. In this case is 12%. So the dividend, remember, always we need in ringgit. So 10% times 100 ringgit per value is 10 ringgit. And divide by 12%, 10 ringgit divided by 12%. Here we get 83 ringgit and 33 cents. So this is the intrinsic value. And similar like bond, we can compare between market price versus valuation of preferred stocks. So again, if market price is higher than valuation of preferred stocks ataupun the intrinsic value, this is overvalued. Okay, overvalued. If the market price is less than VP, this is undervalued. It's overvalued. So in this case, the market price, RM90, is more expensive as compared to the VP, 83. So if this is the case, this is overvalued. Okay, overvalued. So if it's overvalued, our suggestion would be, since the question asks about advisable to buy, so therefore we advise do not buy because it's overvalued. Okay, remember overvalued, do not buy, or if the question asks us whether to buy or to sell, then we're gonna advise to sell if it's overvalued. Okay, but for undervalued, obviously we're gonna advise to buy, and if the person asks whether to buy or to sell, we're gonna say do not sell. Okay, ataupun to buy lah basically kalau dia undervalued ataupun kalau nak jual, we advise not to sell it. Okay, not to sell it. Okay, that's it for preferred stock VP. Okay, but sometimes, again, similarly like before, the person might ask you to find, let's say, the K instead of the VP. Okay, here, the person asks about the rate of returns. Okay, simply, actually, we just swap positions. But instead of VP, we're going to use the market price. So usually, if the question asks you to find the rate of returns, the K, obviously the price will be given. So the price that we're going to use is the current price. Okay, and the rest are the same. This must be in ringgit per annum. Okay. So for example, this question 1, example 2, Ali Berhad's preferred stocks pay a quarterly dividend of 250. And if the current price is 50 ringgit, what would be the required rate of return ataupun the nominal annual rate of return? So if this is the case, you're going to use this formula, the K, because the question asks you to find the returns. Again, if you cannot remember or you think it's too much formula you need to memorize, you can use this formula juga sebenarnya. Okay, cuma you substitute je lah. Okay, the K will be at the back here, whereby the unknown will be the K, but the price and the dividend is from the question. Okay, but anyway, the dividend in this case is 250, but remember this 250 is quarterly. This is a quarterly dividend. Remember, our dividend must be in annual amount. So therefore, our dividend would be 250 times 4. Okay, and our market price is 50 ringgit. This one. So 10 ringgit dividend by 50. So here we're going to have a 20% required rate of return. Okay, so the K is 20%. So this is how we try to solve the required rate of returns for preferred stocks. So that's it. For preferred stocks, there's only two possibilities. Either they ask you to find the VP or the rate of returns. That's it. Very straightforward. But in fact, you just memorize this formula, you can answer both questions. Okay. Now, any questions for preferred stocks? Okay, let's try some questions here. Here I have some exercises. But obviously, this is a combined one, from question 1 until question number 9. So we just focus on the questions related to preferred only. So for example, here, the first two questions. Okay, question number 1 and question number 2. So I'm gonna move this down a bit so that I can write. Okay, so for the question number 1, Firdaus has 2 lots. Okay, this is a question. Has 2 lots of preferred. They specify directly here, preferred, then we know this is a preferred stock question. The stocks currently sell for 32 ringgit and pays a quarterly dividend of 90 cents. So we know this is a quarterly, quarterly. So we need to annualize the dividend. So annual dividend would be 90 cents times 4, which is 3 ringgit and 60 cents. So this will be the annual dividend for this question. So 1-1, okay, compute the expected rate of return. And should he buy more shares if his expected rate of return is 10%? Okay, provide your reasons. So therefore, and if I move this down, the first question asks about the expected rate of return. So this is K. The question asks about the K. So we know the dividend is 360. And the current price is 32 ringgit. So 360 divided by 32 ringgit would be 11.25%. 11.25%. So this is the rate of returns for this investment. So the question asks, should Firdaus he buy more shares if his expected return is 10%? Okay, his expected return is 10%, and this preferred stocks provide you with 11.25%. So what would be your suggestion? Okay, should he buy more? Yes. Okay. He should buy more shares.
Doktor,
Yeah.
can I ask, because dia kata dekat sini kan, Firdaus has 2 lots of preferred stock. So like dia ada 2 preferred stock, is it?
They already own 2 lots.
Okay, so like dia ada 2 lah preferred stock, right?
2 lots. When
2
we
lots
said
of
lots,
preferred stock.
1 lot equivalent to 100 units. Okay, so when they say that Firdaus has 2 lot, meaning dia ada 200 units existing. Okay, existing dia ada 200 units ataupun 2 lots. So the question asks, should he buy more if his required return is 10%? So obviously the answer ataupun the suggestion should buy more lah, because this investment give a return of 11.25%.
This 11.25% ni is for both lots ke atau just for one lot?
Based on current position, which is they're gonna receive, bayangkan, they're gonna receive 3 ringgit and 60 cent. Okay, 3 ringgit and 60 cents, and this 3 ringgit and 60 cent ni currently sells for 32 ringgit je.
Okay, doktor.
Alright, so yeah, the suggestion ataupun the reason would be, yes, should buy more because the the K is more than their required rate of return lah, ataupun higher than the required rate of return. What should I? It's down. Okay, so that's number one. Now, if Fidau's required rate of return increased by 5%, compute the new minimum price which meets Fidau's requirement. So now the question asks about price. Okay, price. So for the second one, we're going to use the valuation of price atau the valuation of preferred. Okay, so the dividend still $3.60, but if you remember the VP tadi, the formula is VP E divided by K kan. So the K, required rate of return now, increased by 5%. So meaning originally the return is 10% when you expected returns, but now they increase to by 5%, meaning increase to 15%. From 10, increase by 5, meaning 15%. So we're going to divide by 15% here. Okay, so we're going to get the price of 24 ringgit. Okay, but since the question doesn't ask about anything to do with the decision making, so you just calculate lah the new price, which is 24 ringgit. So that's number two lah. So check out the question carefully. What kind of information they want us to find. For this, number one is find the rate of return. So we use K. The second one is about price. So obviously we're going to use BP. Okay, so that's number one. Boleh ke ni? Question number one.
Boleh, Doktor.
All right, so let's try another one. Question number two here. You try kejap. I give you 5 minutes to try this. Question number two. Okay, suppose your friends owns 100 shares. Okay, again, they give a current situation whereby you already own 100 shares. So when set 100 shares, meaning it's one lot lah. Okay, of Alibaba's preferred stocks. The fair price is 52 ringgit per share, and currently paying annual. This is already annual, of 450. So find the required rate of return. So meaning find the K. And next, baru dia tanya, if you require 10% return, should you buy or sell more if this is the price? So this is using VP. All right, 5 minutes. Try this. Okay, boleh ke? So similar like the previous question, it's very much similar. Okay, perhaps maybe a different would be the earlier one. Okay, they ask us to justify whether to purchase more or not based on the rates of return. Okay, but for the second question, they ask us to comment whether to buy more or sell based on VP. Okay, so that would be the difference. So anyway, the flow or the steps how to find it is very much similar. So to find K, the dividend, in this case is 450. So we don't have to multiply by anything because this is annual amount already, 450. And the current price is 52 ringgit. Okay, so 450 divided by 52 ringgit is about 8.65%. 8.65%. Okay, this is the required rate of return. So if you requires 10% return, should he buy or sell more? Sell more. Buy more or sell, good. Sepatutnya. Should he buy more or sell the stock? Because he's already owned one lot here. So to find VP, again, it's 450. But now we divide with the returns, the required rate of return, which is 10%. So 45 ringgit lah kot. Kan? 45 ringgit. Okay, 45 ringgit. So this is the VP. So again, remember this rule, if the MP market price is more expensive, in this case it's more expensive than the VP, because market price is 52 ringgit, VP is 45 ringgit. So this is overvalued. So should he buy or sell? So your justification should be he should sell. Because it is overvalued. Okay, because it is overvalued. Okay, so usually when we talk about preferred stocks, this would give you around 5 to 7 marks. Okay, 5 to 7 marks. Okay, so yeah, that's preferred stocks. Okay, that's preferred stocks. Now let's move on to more technical calculations regarding common stocks. Okay, so unlike preferred stock, which is quite straightforward, for common stocks, we're gonna explore more complicated calculations, slightly complicated lah, tak adalah complicated sangat, but just a slight calculations with regards to the calculations. So again, we're going to discuss the characteristics and features first about the common stocks. Partial, I already mentioned earlier during the preferred stocks punya discussions, we already touched a bit about common stocks. And here, by definition, common stock refers to equity sources. So when we talk about the types of source for common stock, they are equity type. Remember, kalau kita cerita pasal debt, this is referring to bond. So when we talk about equity, this is referring to common stock. Okay, and in fact, preferred, as I said, preferred is a hybrid and hybrid. Technical, they share both debt and equity punya element, but from accounting point of view, preferred, they're going to put under equity as well. Okay, dia letak under equity, but they are not the owners. Okay, they are not the owners. For preferred, tapi for common stock holders, they are considered the owners of the company, and therefore, any net income ataupun net profit generated by the company belongs to the owners. So that's why, in terms of returns, okay, common stock holders will not have a fixed returns. technically. Okay, they're gonna have returns depending on the performance of the company. So their returns are not fixed, and they might have a higher returns if the company performs very well, and they might not receiving any dividend at all if the companies perform bad that year. So that's why in terms of risk, the common stockholders will be the highest risk as compared to the three that we have earlier. We have bond, we have preferred, and last now is the common stocks. So in terms of characteristics, as I said earlier, any claims, the common stockholders will be the last one to be paid. Okay, the last one after the bondholders, which is the first one to receive. Second is the preferred, and the common stockholders will be the last one, okay, to receive. Okay, so in terms of preemptive, remember tadi, similar like preferred stockholders, yes, they have the rights to purchase additional shares, okay, but this is not obligation. This is not compulsory. So meaning as current common stockholders have the rights, okay, rights but not obligation. Okay, so this is another thing that we've discussed also earlier, the voting rights. Yes, for common stockholders, they have voting rights. So example here, ditulis kat sini, permitted to vote for board of directors, okay, issuance of new shares, when we talk about mergers and acquisitions, okay, so all major decisions, major decisions, so the common stockholders can vote, okay, can vote. Okay, the rest nanti you baca. Maybe a bit about the types of common shares. So here we're going to discuss 6 types. Sekejap, So we have 6 types. So first, we're going to discuss about growth stocks. So growth stocks simply means we can consider them as a new company. Okay, they are new company, but with potential. Okay, so stock experience high rates of growth. Okay, so they might have a very good what we call current price appreciation. So meaning in terms of price, if you look at their share price, the share price might increase from one time to another very sharp in terms of the price. Okay, but one characteristic of growth stocks, their dividend payment. Okay, their dividend payment usually low. Okay, so the price appreciation will be high, but the dividend would be low. Why? Because this company is considered new. Okay, when we talk about new company, especially with potential, growth potential, they requires frequent ataupun continuous capital injections. Okay, they always need capital in order to grow. So where the capital comes from? So the capital can come from the profits of the company. Again, if you remember this rule, when the company generate net profit, okay, net profit kat sini, they're gonna pay dividend the shareholders, okay, preferred and even common stockholders. And the rest of the money, they will put it in the reserve in the form of return earning. Okay, so this is very important rule that you need to remember. From the net profits, they will pay dividend to the shareholders, both preferred and common stockholders. And the rest of the money, they will reinvest in the company in the form of return earning. So for the growth stocks, okay, when whatever the net profit that they generated, most of the profits will go to this side, to the return earning. So this part, the dividend would be low. This retaining will be high. Why? Because retaining is reserve, so this reserve can be used for future expenditures, okay, future expansion, for example. A lot of things can be used using their reserves. Okay, as a growth companies, usually the dividend will be low. So that's why the low dividend payout ratio ni akan jadi rendah lah, very low. and also low dividend yield. Reason being, as I said, as a new company, they need capital all the time. So whenever they generate profits, this profit will be focused more on the return earning side. So as investor, okay, if you intend to get dividends for growth stocks, you shouldn't look elsewhere, ataupun you should look elsewhere. Okay, you shouldn't invest in growth stocks if you intend to get high dividend. Tapi for high price appreciation, yes. When we talk high price appreciation, bermaksud let's say in Jan, the price is RM1. March, the price increased to 190, for example. So the 90 cent increase ni is called price appreciation. Price increase ataupun price appreciate from time to another, from one time to another. Okay, so as investor, you have two ways to get returns. Number one is the dividend. Number two is price appreciation. So for dividend, yes, it will be low, but in terms of price appreciation, yes, it's a potential to have higher higher increment lah in terms of price appreciation. So that's growth stock, stock. The first type. The second type is income stock. So this income stock comes with long and sustained records of paying higher than average dividends. So unlike growth stocks yang pay low dividend, for income stock, they pay higher than average. Okay, so it's not considered the best returns, but it is considered good return. Okay, good for investors looking for relatively safe return. So for those who are considered as less risk taker ataupun low risk taker, this is the type of stocks you should invest in, income stocks. So dividend tends to increase over time. Okay, unlike bond, if you recall, bond, the returns are fixed, kan? So if you invest in common stocks, the return will not be fixed, okay, but instead it will increase from time to time. Okay, and usually the companies that belongs to this income stock will pay high dividend simply because they don't have potential to grow anymore. The limitation with regards to growth potential. The company is already established. They have fully developed their infrastructure, so they don't have anything to expand anymore for time being, for example. So instead of keeping in the return earning, they will pay high dividend. Okay, and they just keep a minimal return earning. Okay, so that's income stock. Okay, number 3. So this is considered the best. Okay, the best in the respective industry. So it's the stock is called the blue chips. Okay, financially strong, high quality stocks. Okay, with the long and stable records of earnings and dividends. So this is considered better than income lah. Okay, income stock pun dah ada long and sustained records, but this is much better in terms of the records. Okay, relatively lower risk. Okay, if you invest in these blue chips, you shouldn't worry too much about the performance of the company because the companies are very, very strong fundamentally and financially. And they are considered the leaders in their respective industries. So in Malaysia, if you want to look the blue chips, okay, go look into, for example, FBM, FTSE Bursa Malaysia, ataupun ya FTSE Bursa Malaysia, KLCI constituents. Okay, or maybe I can help you to find it. Just give me 1 second. Okay, so before we look at the constituents, so in stock market, okay, common stocks are the ones yang kita tengok ni lah, under the equity side, and for Bursa Malaysia, we have a lot of index, okay. So the plural for index is indices, by the way. Anyway, so this you can see here the types of index that we have. Okay, first we have FVM, KLCI, FTSE Bursa Malaysia KLCI, which have 30 companies in this list. Okay, in the index we have 30 top companies. And next we have FVM mid 70 index. So this is the next 70 companies. Okay, so first we have top 30, then we have mid 70. So 30 plus 70, we have the next index is a combination of the two, which is the top 100 index. Okay, so when we talk about blue chip just now, we can refer to this LVM KLCI because this list has 30 companies. So the companies includes these companies, right? So it comes from different industries. For example, Axiata, as you all know, this is telecommunication, telco. We have CIMB for the financial institutions, Patalega, Hong Leong Bank. Okay, Hong Leong, we have two here, Hong Leong Bank, Hong Leong Financial Group. We have KL Kepong, this is property developers, Maybank, Maxis, MIC for the shipping, transportation industry, MIC, Maxis, Telco also. Nestle, consumer products, okay, Petronas. So we have 30 companies. And last updated last year, 2020. Okay, Telecom. So, some, as you can see here, some are government linked companies, right? Like Tenaga, Telecom, Sandabi, right? So those are quite significantly owned by government linked companies lah. Okay, so these are considered as a blue chip companies. Okay, leaders in their respective industry. Okay, so they are blue chips. So this is very much popular for investing public. So if you want to invest in the future, so this is one place to start. Look in the top 30 ataupun in the HVMKCI list. And they offers both in terms of price and also in terms of the returns, in terms of the dividend. Usually, if you compare between all, the blue chip companies usually will offer you the highest returns in the form of dividends. Okay, so they are very strong fundamentally. Therefore, if the markets is not doing very well, they will survive. Okay, they will survive. Okay, so only one downside of blue chips. Okay, the price might be expensive. Okay, the price of the stocks might be expensive if compare with other players in the same industry. Okay, so the downside ataupun the disadvantage would be the price might be expensive. That's number 3. Number 4, cyclical. Okay, so the keyword here is cycle. Cyclical is referring to the cycle, either the economy cycle ataupun the business cycle. So the performance of the company work closely with the performance of the general state of the economy. So in other words, if the economy is doing well, the companies will perform well. But if the if the economy is badly hit by something, like now, for example, during pandemic, the companies will be affected. Okay, so the price will go up and down according to the business cycle and also the economy cycle. Tend to do well when the economy is growing. Okay, but they will do poorly during slow economy. Okay, so they will move up and down according to the business cycle, okay, and also the general state of economy. Okay, so they move closely with the economy, right? So that's why we call them cyclical, or they will work in cycle. Okay, but the opposite of cyclical, which as I recap tadi, cyclical means they will the performance closely related to the economic position, whether it's growing ataupun slowing. Kalau growing, the company will do well, but if it's slow, the company will do poorly. Tapi for the fifth one, the defensive stock, number 5 here, okay, unlike cyclical, they will do well ataupun they will at least hold their positions even the company is faltering ataupun slowing down. Even if the economy is slowing down, they tend to hold their values. Okay, or some of the companies might even do better if the economy is going down. Okay, so that's why we call them defensive stocks. Okay, the stock remains stable, at least stable, or they can increase as well during economy slowing down. And usually these types of stocks related to companies producing products which are considered staples. Okay, staples ni product that we use on daily basis. Okay, for example, electricity, foods and beverages. Okay, whereby especially the ones that we use most of the time lah, rice, sugar. Okay, so the one that we always need it. Okay, food kan. It doesn't matter whether it's good or bad time. You still need to purchase foods, for example. Okay, so the basic necessities are not the premium ones. Okay, not the premium ones, not the expensive ones. Okay, so gold stock also a form of defensive. Okay, gold stocks. And finally, number 6 is speculative. Okay, stocks that offers potential for substantial price appreciation. Okay, and usually speculative stock ni related with companies that produce IT related or maybe satu lagi example dia apa something related with machineries lah, machineries. Okay, machineries can be cars, it can be machines. Okay, right? So these types of speculative stocks, usually not all ITs. For example, kalau kita cerita pasal Apple, obviously it's not speculative lah. But there are some IT or machineries kind of producer ataupun manufacturer which has lack of sustained track records. It's a new company, for example. Maybe okay, example tak tahu nama company but yeah, just imagine one company with the launch of new product in the market. Okay, obviously kalau the product is doing well, then we can expect the price to appreciate. Okay, price to appreciate. However, the next round, if the company doesn't provide or produce new products that is acceptable in the market, the price can depreciate very fast. So that's why we call them speculative, because the unpredictability of their earnings, it depends on the performance of their products in the market. Okay, so therefore they has a potential to appreciate, but at the same time they can go down very sharply as well. So for speculative, this is only suitable for investors who knows the market very well, know when to enter the market or to leave the market in order to gain profits. Okay, so for this speculative, people don't invest for dividend. Okay, they will not invest for dividend. Okay, because for this type of company, usually the dividends can be considered zero dividend. Okay, they don't pay too much dividend, but it is suitable for those who want to get price appreciation. Okay, why we need this price appreciation? Because technically for investments, I think you've heard about this. will buy during low price, and you will sell it when it's high price. Okay, buy low, sell high. So when we talk about price appreciation, kalau the graph is increasing like this, you're gonna buy it here, you're gonna sell it later at higher price. So for speculative stocks, you need to know when is the graph is going up like this, because sometimes the price can go down like this, kan? So you need to know when is the market improvement and declining. So you need to know. So this is only applicable for, I can say, the experts of speculative stocks. Okay, so again, you can read lah nanti advantages and disadvantages to the investors and also to the issuers. Right? And remember, when we talk about common stock, we are talking about the owners of the company. Okay. Before we go into the stock valuation, maybe we take a short break lah. Sekarang 10:20, sorry, 3:20 something. So you're going to take a short break and we're going to restart at 3:30 where for the stock valuation. And again, if you remember, for bond, the valuation is VB. For preferred, just now, we use VP. Okay, but for common stocks, we drop the V. We just focus on the price. Okay, this is not zero. Sorry, this is not O. This is zero. P0. Okay, P0. Okay, so in mathematics, in economy, when we put zero, okay, P0 for example, the zero refers to today's value. Okay, ataupun now. Zero refers now. Kalau kita letak P1, it refers price in 1 year's time ataupun price next year. Kalau P2, price in 2 years' time, for example. Okay, and so on lah. So when we talk about P0, it indicates the price of the stock today. So that's why one of the value ataupun the terms that we use is price of the stock today, which is P0. And these are the terms that they might use. The intrinsic value, still we're going to refer to the intrinsic value, IV, the real value, fair price, present value. So all of these are referring to the same thing, which is to find P0. And the rule still the same. Okay, the undervalue and overvalue still the same. So you're gonna use the comparison between market price, but now between market price and P0, it's more overvalued. So kalau market price is lower than the intrinsic value, this is undervalued. Okay, sama lah. Okay, the rule still the same. Okay, buy, do not buy, or hold, or sell. Okay, the same rules apply here. Anyway, before we look at the valuation, we're gonna restart back at 3:30. All right, so let's continue with the valuation of common stocks. So for this valuation of common stocks, we have actually a lot of methods that can be used. Okay, so we have PE ratio using the earning multiplier, the book value method. So this one for EE14, you're gonna discuss this later. Not later this semester lah. I mean, in the future, we're gonna discuss this PE ratio ataupun earning multiplier techniques during investment portfolio. Okay, but not for the rest lah. Only for EE14 students. But for us now, okay, we just focus only on this method. Call them as dividend discount model, DDM. Okay, so for this dividend discount model, the keyword here is discounts model. Discount. So if you remember from our previous topics in the value of money, if we want to find something, let's say 5 years from now, okay, here, This is what we call as the process of compounding. Okay, compounding. Okay, but if you want to find something from the future to today's value, it has the name to find the present value. In the present value, this is the process of discounting. So that's why we call them dividend discount model. We are discounting the dividends of the stocks to find what will be the price of the stocks today. And in fact, it's not only dividends, we're gonna discount the price as well, the selling price. So this is based on DDM, dividend discount model. We're gonna assume that the stocks will give us dividends. Okay, for example, we have 5 years here. We have 5 years of dividend. And we're gonna assume also we're gonna sell the stocks in 5 years' time at a selling price here. So what we need to do is to discount all of these dividends. So we have 5 years of dividends together with this selling price to today's value. Okay, so we want to find the present value of all of these inflows. The dividends, 5 years, and one selling price. So we're going to discount the dividends and the selling price. So that's the, in a nutshell, the dividend discount model. Okay, but if you refer to our time value of money before, we use the table. If you remember, we have 4 tables. The present value, we have 2 tables, the PVIFA and PVIF tables. Okay, but for this common stock valuation, we're not going to use that tables. We're just going to use the formula. Okay, and that formula is actually referring to the present value formula as well. But yeah, we're not going to use the table. And in order to solve the problems with regards to the common stocks valuation, we're going to split the dividend discount model into 4 different models, 4 different categories or 4 different types. Okay. The first one is known as constant amount of dividend. Or in other words, this is a fixed dividend. Okay. Even though the characteristic of common stocks before, we said that the dividends are not fixed, but from theory point of view, we can estimate the price of the common stocks, okay, the P0, based on the first model, which is based on the fixed dividend. Okay, so that's our first model. So the first model is known as constant amount of dividend or fixed dividend. The second model is based on inconstant amount of dividend. So the word inconstant here refers to the amount of dividend which is different from one year to another. So the very best example is just like what we saw earlier, this one. Okay, so this is example of inconstant dividend, whereby the amount of dividend differs from one year to another. Okay, for example here, 30 cents and then drop to 20 cents, remain 20 cents in the third year, and then increase to 25 cents in year number 4, then increase further to 40 cents in year number 5. Okay, so this is an example of inconstant amount of dividend. So the amount of dividend change from one year to another. Kalau based on the first model, it will be, let's say, 50 cents every year. Okay, so this is constant amount of dividend ataupun fixed dividend. Okay, so this is the second model in constant amount. Right. The third model, okay, is known as constant growth rates of dividend. Okay, so for this third model, we're going to assume that the rates of dividend will increase ataupun the amount of dividend will increase every year. Hence the word growth ni. So therefore, we're going to have one growth rate. Okay, because the dividend will increase at a certain specific rate of growth. Okay, example, current dividend is 1 ringgit. Example, yeah. This is for growth, constant growth. For the next year, okay, this dividend of RM1 will grow by 10%. For example, if the growth rate, the G growth rate is symbolized with G. So let's say the G is 10%, the growth rate is 10%, for example. So meaning if current or today's the dividend is RM1, so we will assume that the dividend will increase by 10% next year. So if we increase by 10%, next year the dividend will be at RM1.10. So today the dividend is RM1. Next year it's gonna be RM1.10. And we're gonna assume this growth rate will remain constant. It will remain 10% every year. So meaning if you want to find dividend for the second year, we're gonna increase this RM1.10 by another 10%. Okay, 10%, it will be RM1.21. And it will keep on increasing by the same rate of growth, 10%. Okay, and again, this 10% is just an example. Okay, so the growth rate, we're gonna have only one. Okay, it's gonna be constant ataupun fixed in terms of the growth rate of return. Okay, but for the fourth model, it is inconstant growth rate. So meaning they're gonna have more than one, okay, or sometimes we can call them as multiple growth rates. Okay, so instead of one for the fourth model, they're gonna have more than one. It can be 2, 3, 4, even 5 growth rates. So meaning the growth rates will change from one year to another. So for example, for first and second year, the growth rate will be at 10%. Third year onwards, okay, the growth rate will be at 15%. Okay, so here we have at least more than one. So we have at least two here, two growth rates. The first 2 years, the growth rate is 10%, but for third year onwards, the growth rate will be at 15%. Okay, kalau yang number 3 tadi, the G will remain at 10% forever. The assumption will be the 10% forever. But for the inconstant growth rates, it will be changed somehow in the future. Okay, at least once. The change must happen at least once. Okay, anything lah, 2, 3, 4, 5 times, whatever. So here we have 4 different models, and these 4 models will determine how we will calculate the P0. Okay, at the end of the day, we're gonna find the price of the stocks today, right? The P0. So in order to find the P0, we're gonna calculate based on the models, and the models are differentiated by how the dividends are being paid. Okay, is it based on the fixed dividend, and constant amount of dividend, or based on growth rates? Okay, so we're gonna go from one type to another, and out of these 4, okay, you can see one similarity later on for number 1, number 2, and number 4. We're gonna use the DDM ataupun the discounting method though. The formula will be used in model number 1, model number 2, and model number 4. Okay, with a slightly different formula for model number 3. Okay, but anyway, we're gonna go one by one. We're gonna start with the constant amount of dividend first, the first model. Okay, the constant amount of dividend, or also known as perpetual model. So the word perpetual means indefinitely or forever. In simpler terms, this is actually the rate of not rate, the amount of dividend will remain constant forever. In other words, okay. So based on this model, there are 2 possibilities. There are 2 cases. Number 1, if the question doesn't provide with selling price. Remember, when we talk about P0, okay, ataupun dividend discount model, we're gonna discount the dividends and the selling price. Okay, most of the times they will give you both. Okay, they will give you dividends, they will give you selling price. But based on this scenario, what if the question doesn't provide with the selling price? Okay, and this is only applicable for constant amount of dividend. Okay, only based on constant amount. For the non-constant ataupun growth model, okay, for 2, 3, and 4, we know the returns will be different every year. Okay, for model 2, model 3, and model number 4, our dividend will be different every year. Okay, only our first model will have a constant amount of dividend. Like this one. Okay, only this one yang ada fixed. Okay, but the rest will have some differences from one year to another. Cuma kalau ni, there's no pattern for inconstant amount of dividend. There's no pattern at all, the difference ni. It's just a random different numbers. Tapi kalau model 3 and 4, you're going to see some patterns. They will increase every year, but with a pattern. What pattern? By the growth rates. Okay. Kalau yang number 2 ni, dia akan move randomly. The amount of dividend will be different every year, randomly. Okay, but 3 and 4, it will grow at a certain pattern. Okay, by the growth rates. Okay, for number 3, just one growth rate. For number 4, they have multiple growth rates. But somehow we can see the patterns improvement in terms of the returns. So for 2, 3, and 4, in order to calculate, we need to know the selling price. But for the constant amount of dividend, we can calculate the P0 without the selling price. Okay, so for first case with no selling price, to find the P0, we're going to use this formula. And again, if you look closer at this formula, this is very much similar like our VP earlier. Okay, formula of VP is D divided by K. And it is actually the same formula. Why? If you remember, for preferred stocks, the characteristic of preferred stock, the returns are fixed. The dividends are fixed. Okay, so for P0 with the constant amount of dividend model, this is also refers to fixed dividend. So that's why we can share the same formula. Okay, share the same formula here. Okay, so D is again dividend, annual dividend, and K is the required rate of returns. Okay, so let's look. I skip this one first. We goes to the example number 1 here for common stocks. An investor just bought a stock that pays constant dividend of 2 ringgit. So this is the dividend, the D, every year. And if he requires 10% return, find the intrinsic value of the stocks. So to find the intrinsic value, the P0, the dividend is 2 ringgit. And the K is 10%. Okay, 10%. 10%. So we have the intrinsic value of 20 ringgit. Okay, so this is the P0 or the intrinsic value, 20 ringgit. So based on these calculations that we've done earlier, state whether you buy the stock if the market price is 30 ringgit. So this first situation, the market price is expensive as compared to the P0. So this is overvalued, 30 ringgit. 30 ringgit is more than 20 ringgit. So this is overvalued. For the second scenario, the market price is less, okay, 10 ringgit is less than 20 ringgit than the intrinsic value. So this is undervalued. So for undervalued, yes, we buy this one. Okay, so for the justification, still the same. We still going to refer to the same justification. Okay, and this is applicable for the first model if there's no selling price. Okay, if there's no selling price. But like I said, 99% of the time, they will give you selling price. So therefore, most of the time, we're not going to use this formula. Instead, we're going to use this formula. So this formula is very important because we're going to use this formula for multiple models. Okay, for model number 1, we're going to use this formula. For model number 2, also we're going to use this formula. And for model number 4, okay, the inconstant growth, one of the steps, we're going to use this model as well, or this formula as well. Okay, so this formula is applicable for 3 out of 4 models. Okay, so let's dissect the formula. Okay, so it's still P0. Okay, P0. The formula will start with D1. Okay, not D0. We're gonna start with D1 dividend for the next year's dividend. And we're gonna divide it with 1 plus K. Okay, to the power of 1. So D1 divided by 1 plus K to the power of 1. So what is D? D is dividend. K dividend for year 1, kalau D1 and K is the required rate of return. So 1 plus K. So if it's 10%, it's 1 plus 10%, 1.1. Okay, and then we add with dividend for second year, D2, divide by 1 plus K. And since this is for the second year, we're gonna power the 1 plus K with 2 as well. Okay, and if we have 3 years, then we're gonna add with plus with D3, 1 plus K to the power of 3, and so on. So that's why I put plus DN. N here refers the final year. Okay, the final year of dividend that we calculate. Okay, so for example, bear with me. If we want to solve these problems for this example, we have 5 years of dividend, yeah. So meaning we're gonna add D1. This is our D1, dividend year 1, 30 cent, plus D2, 20 cent, plus D3, plus D4, plus D5. So we're gonna have 5 years of dividend. Okay, D1, D2, D3, D4, and D5. And we're going to add lastly with the selling price. Okay, and this selling price, since this is happened in year number 5, this is technically price number 5. Price for year number 5. Okay, the 5 ringgit. Okay, so again, I use N here refers to the same N here. So if we have 5 years of dividend, so meaning we have up until D5, and this D5, we're going to divide with 1 plus K to the power of 5. Okay, so our price at the end here is referring to P5 as well. So this N must be consistent. So we have 4 N's. One for dividend, one for price, and both with a power of N. So again, I recap, if we have 5 years of dividend, so N kita dah identify as 5. So all N's will have 5. So meaning D5 divided by 1 plus K to the power of 5 plus price for the year number 5 divided by 1 plus K to the power of 5. Okay, so that's N. N refers to the year of our final dividend. So it depends. It can be 5 years, it can be 3 years, 4 years, and it must be more than one. Obviously, it will be more than 1 year. Okay, minimum 2 years, maximum, there's no maximum lah, basically. Okay, but for the question, expect between 5, 6 maximum, 7 seldom. Okay, usually between 3, 4, 5, 6 years of dividend. Okay, 3 to 6 is within that range. Okay, but don't limit yourself. Sometimes they can ask you up to 7 as well. Anyway, this would be the model that we're going to use, okay, most of the time. So going back to the question, okay, this one. For this example number 1 for all common stocks, they don't provide us with the selling price. So therefore, we cannot calculate using this model because we don't have this price. We know the dividend will be the same because the dividend is 2 ringgit every year. Okay, we have the K as well, the 10%. But we short off the selling price, the P we don't have for this example. So that's why for the next one, they extend the question, okay, based on the first example. Now the investor wants to sell, okay, the stock after 3 years with a price of 50 ringgit. Okay, so this is our price in year 3 because they want to sell it in year number 3. So find the intrinsic value of the stocks. We know the dividend is 2 ringgit because it's fixed. And the required rate of return is 10%. Okay, based on this example. Now we have the dividends and we also have the price. We can find the intrinsic value, the P0. Okay, So our dividend will be RM2 every year. Okay, plus RM2 for the second year, plus RM2 in third year. Okay, remember our concept, we're going to discount the dividends according to the time, the years, and we're going to discount the price. So meaning we have multiple dividends with one price. And this price will be price year number 3, RM50. Okay, so we have 3 dividends, 1 selling price. And remember the N. Okay, so N is 3 years. So therefore, we're going to define N as 3. So if we define N as 3, so the last one, the final dividend will be D3, P3 divided by the power of 3, also the power of 3. So meaning, it will be 1.1, 1 plus K, 1 plus K is 1 plus 10% is 1.1, RM2 divided by 1.1 plus RM2 divided by 1.1 squared. One put a bracket here. And the third one is 1.1 to the power of 3. Okay, N is 3, right? So our last also will be to the power of 3. Okay, so this N must be consistent, the last one. Okay, must be consistent. So now you have all of this, we can calculate lah. So RM2 divided by 1.1 plus RM2 1 squared plus RM2 divided by 1 to the power of 3 is RM50, 1 to the power of 3. So here is RM42, 4 cents. Okay, so this is the intrinsic value of the stocks based on the dividends and also the selling price. Okay, so this is our first model. Okay, and the characteristics is the dividend is constant every year. Okay, with the one selling price. Moving on to the second model. Okay, we're going to use the same formula, the very same formula. Okay, the very same formula here. Okay, but as you all noticed earlier, based on this one, we have a different dividends every year. So that's our second model. Okay, second model still gonna same we have the same formula, constant amount of dividend. Okay, for example, like this one. Okay, the first year is RM1, the second year is RM1.20, the third year is 80 cents, and the final year, year number 4, is RM1.50. So we have 4 years of dividend. So N equals to 4. So you're gonna have 4 dividends plus 1 selling price, and the selling price is RM30. Right, and the question asks to fund the fair value with the required rate of return as 10%. So meaning you're gonna use the same formula P0. So the first year's of dividend is RM1. The second year is RM1.20. The third year is 80 cents. The fourth year is RM1.50. And we're gonna have one selling price, which is RM30. Okay, and remember the N. So since we have N until year number 4, so our final price would be to the power of 4 as well. Okay, so meaning the K is 10%, so it's 1.1. 1.1 to the power of 2, 1.1 to the power of 3, 1.1 to the power of 4. Final one will be to the power of 4 as well. So be careful, don't keep on increasing your power sampai the last one ni nanti tiba-tiba letak to power of 5. No, our price, okay, the power ni must consistent with the final dividend. Okay, it's not increasing anymore. It will stop at the 4, then we're going to use 4 for the price. So berapa ni? Okay, so you're gonna get here sepatutnya RM 24 and 2 cents. So this is the intrinsic value or the fair value of the stock. Okay, 24 ringgit and 2 cents. Okay, using the very same formula. Okay, so as I said, for model number 1 and number 2, it's pretty much the same formula. Together with stock, model number 4, but for model number 4, this will be the final step. Okay, we're going to have 3 steps. The final step, we're going to use the same formula. Okay, but the first 2 steps, I'm going to show you later lah for model number 4. Okay, now moving on to the third model, okay, the constant growth model, model number 3. Constant growth model, also known as Gordon model. Okay, so out of 4 models, this will be the simplest in terms of formula. Formula very short, only this formula. And we're gonna assume we're gonna have one growth rate. And this growth rate we symbolize with the letter G. Okay, this G. So you're gonna see dividend for the first year, D1. Divide by K minus G. K again is the required rate of return. K required rate of return. And G is the growth rate. And remember, for this constant growth, the G, we only have one G in the question. And for this model, we're going to assume that the K, the required rate of return, always bigger than the G. Okay? We shouldn't get a negative sign here. So K minus G must be positive. That's why the K, we assume, going to be more than the growth rates, higher than the growth rates. Okay. Now, for this constant growth model, you need to be careful of one thing, okay, regarding the dividend value. So what would be the scenarios for the question? So there are two possible ways, two possible situations here with regards to this D1. The question, okay, the question can provide you either current dividend, okay, current dividend. So the current dividend will be symbolized with D0. This is current dividend. Sometimes they might use the word recently paid. Okay, recently paid ataupun sometimes just paid dividend. Okay, so look for keywords. So in short, to determine whether it is D0, look for keywords. Current dividend, recently paid, or just paid. Anything got to do with dividend is already being paid, or that's the current dividend lah, basically. Okay, so if the question provide you with D0, current dividend, okay, so the question, the formula is D1. So to find D1, you need to use this formula, the one in the cloud here. So to find D1, it's D0, which is this one, multiply with 1 plus G. Okay, multiply with 1 plus G, whereby G is the growth rates. It's just like what I showed you earlier. Remember tak tadi yang ni? This one. I have here lah to find D1, kita multiply with 1 plus G. Okay, and then we divide lah with K minus G. Very straightforward. However, okay, not all the time they will give you D0. Okay, it's not necessarily all the time current dividend. Sometimes the question might give you D1 straight away in the question. So how to differentiate? They use this word, the one that I bold here. They use the word expected or next year's dividend. Okay, so if the question gave you, okay, the expected dividend of this company is RM1.20, automatically when they use the word expected, that RM1.20 is D1. So if it's already D1 in the question, just put that straight away in the formula. You don't multiply with 1 plus G anymore, because if you use D1 and then you multiply with 1 plus G, again, bear with me, macam ni tadi. If you use D1, RM1.10 ni, and then darab dengan 1 plus G, technically you are actually finding D2. Okay, so if the question already give you RM1.10 in this case, RM1.10 as D1, so you're gonna use RM1.10 straight away in this formula. Don't multiply with 1 plus G anymore, because if you multiply with 1 plus G, technically you are finding the following year's dividend, which is D2, and so forth. Okay, so that's the only thing that you need to be careful. Okay. So first thing you need to determine whether the dividends given in the question, is it the current dividend or the expected dividend? Okay. Then you can proceed with the calculation of P0. That's it. Example here. A company just paid, okay, they use the word just paid, dividend of 50 cents. So automatically this 50 cents, you know, this is D0. Okay, kalau you ubah, the company is expected to pay. Example. Then this expected to pay, this 50 cents will be D1. Okay, so again, read the question carefully and look for the keywords. Right? So in this case, it's not expected lah. It is just paid. So we assume this 50 cents is D0. And the growth rate is 5%. Okay, so this is our G growth rate. The required rate of return is 10%. So this is our K. Okay, and look, the K and G, the K must be higher than the G. Okay, find the price of the stock today. So technically, find the P0. Okay, so the formula is D1. And remember, since the question gave us 50 cents as D0, so to find D1, it would be 50 cents multiply with 1 plus G, and the G is 5%. So 1.05. So this is the whole thing here. The formula here is to find D1, like this one. Okay, D0, 50 cents, multiply with 1 plus G, 1 plus 5%. And divide by 10% minus 5%, K minus G. That's it. That's why I said the easiest model would be model number 3, because it's very short, the formula. 5 divided by 5%. So here we have 10 ringgit and 50 cents. Okay, 10 ringgit and 50 cents. That's it. This is how we find the price of the stock today, or the intrinsic value, using the third model. And to determine whether this is the third model, we're going to have a growth rate. Okay, a growth rate. And this growth rate, there's only one of it, which is 5%. Okay, dalam case ni 5%, then only one growth rate. So this is based on model number 3. And if it's model number 3, this is the formula. Okay, before we move to the fourth model, I want to recap balik the first 3 models. All of the example I use, okay, all asking us to find the price of the stock today, the fair value, the intrinsic value, the present value. Okay, just to let you know, there's a possibility of the question, okay, regardless of the model, ask us to find the price of the stock, which is not today, the price in the future. Okay, the question can ask us to find the price in the future. For example, kalau based on the first and second model, okay, first and second model, formula dia sama yang ni. Instead of P0, the question asks us to find price of year number 3, P3, for example. So if that's the case, usually when we talk about the first and second model, the P3 will be the one at the back. So meaning they will give you a current price. Okay, they will give you a current price, and then there's a set of dividends. And the question will ask you to find the price in the future. Let's say price for the year number 3, P3. So if that's the case, okay, you're gonna use the same formula. Okay, you still gonna use the same formula, but the one that unknown is this one at the back, PN. Okay, P0 or the current price will be given. The dividends will be given depending on the model, either constant ataupun inconstant. But the ones missing will be the price in the year, the final year, the PN. So you're gonna use or ataupun you're gonna insert all of the information except for the PN. Okay, and then mathematically solve lah how to find the price of the future values. Okay, the PN. Okay, the rest will be given. Okay, so you need to solve it mathematically lah, one by one, sampai dapat PN. That's number one. The question might also ask you to find the K, mungkin. Okay, but for inconstant ataupun constant amount of dividend, usually besides P0, they might ask you to find PN. That's it. Okay, it's either D1, it's either P0 or PN. So technically, they're going to ask you to find the price for model number 1 and model number 2. Okay, but for model number 3, okay, under the constant growth, besides P0, they might ask you to find the K, they might ask you to find the G, or they might ask you to find the price in the future as well. Okay, so kalau lah they ask you to find K and G, again, similarly, they will give you P0, you need to find the D1, the K is missing, but the G is given. So mathematically, you need to solve it similarly like before. Also for G, okay, either K or G, so the rest will be given, only one item missing. Okay, very straightforward. But what if the question asks, macam ni? Okay, it's the same question. Okay, the company just paid dividend 50 cents, growth rate is 5%, required rate of return is 10%, but the last question dia tanya, find the price of the stock 3 years from now. Okay, I ubah from stock today to 3 years from now. So technically, it's not P0. You're going to find P3. Okay, for the third model, okay, we can make adjustment to this model. This model is actually based on a base model of PN. Okay, this is the model sebenarnya. PN is D n plus 1 K minus G. So this is the basic model. Okay, the basic model. And we can adjust this model to fit this. So meaning, to find P0, so n is 0, imagine, to find P0, which is n equals to 0, so 0 plus 1 is 1. So it's D1 K minus G. So it fits this one. Okay, so we alter n with 0. Okay, so ni 0 plus 1, it means 1. So D1 K minus G. So it fit this one. So meaning kalau lah soalan saya cari P3, okay, we're going to use 3 as our n here. So if it's P3, it's D3 plus 1. So meaning it will be D4 K minus G. And so on. So any you can substitute with whatever numbers question want us to find. And whatever the case for the price, we're going to add 1 for the dividend. The numbers, the numbers. Bukan the value of D, the number of n we add 1. So kalau P3 is D4, kalau P5 is D6 and so on. Very straightforward. Okay, with the K minus G lah, we divide with K minus G. So going back to this example, if the question, instead of try to find the price of the stock today, asks us to find the price of the stock 3 years from now, which is P3, technically we're going to find D4. Kalau tadi ni D1, okay, so we're going to find D4 with K minus G. So the one at the bottom still remain the same, but the numerator, okay, will be different. Okay, kalau kita buat ini, this is D1. Okay, But to find D4 like this, simply we power 1 plus G. We're going to power the 1 plus G with the number of years that we want to find. So meaning if you want to find the dividend for the 4th year, the year number 4, we're going to power the 1.05, the 1 plus G with 4. That's it. So power 1.05 with 4, then multiply with 50 cents, then we're going to get the dividend in year number 4. So meaning 1.105 to the power of 4 times 50 cents, you get 0.61, okay, divide by 5%. So here the price would be 12 ringgit and 16 cents. So this would be the price in year number 3, 12 ringgit and 16 cents. Okay, so be careful of the question. Read until the end of the sentence. The question asks us to find the price stock today, which is P0 or something else. Okay, so if it's something else, you need to make adjustment using this basic model. Okay, so P3, P4, P2, P6, whatever, you can find the price for the future simply by adding n plus 1 to the dividend. Okay, and when I said plus 1, dia bukan value dia plus 1. It's not 50 cent plus 1. It's 1 ringgit 50 cent. No. Yang kita add 1 tu is the value of n. Okay. And to find, again, I recap, to find the value for that particular year, we just power the 1 plus G part with the year. So kalau nak cari P5, for example, if P5 is D6, kan, D6, so therefore it will be 1.05 to the power of 6 times 50 cents, the current dividend. And this rule applicable for D1 as well. So kalau lah dah memang D1 kat sini, and you want to find D4, so you don't have to power sampai 4, sebab kalau you power 4, it means that you try to find D5. So it defeats the purpose of ataupun you slightly miscalculate the information. So you need to adjust accordingly. Okay. So that's the third model. So ada berapa minit lagi? Half an hour lagi. Last model, the fourth model. The fourth model, which is inconstant growth of dividend. This is actually the final parts nanti. We're going to use the very same model as our first and second one. Okay, for the third model. Tapi, in order to solve the third model, we're going to find our own dividends and we're going to find our own price first. That's why we have these first two steps in order for us to complete the third step. So meaning the third steps, we're still going to use this formula. Okay, but if you refer to the first and second model, these dividends and the price given in the question. Okay, but for us, these dividends and the price in model number 4, we need to find ourselves. So how? So first rule, okay, step number 1, to find the amount of dividends, okay, until the G change. I boleh tambah kat sini sikit lah. Until the year of final G change. Okay, I want to know the dividends until the year of the final G change. So meaning, like I said, when we talk about multiple growth model, the growth rates, the G tu can change multiple times. Okay, at least once akan berubah from first growth until the second growth. Okay, so whatever it is, we're gonna find the dividends until the final year of the G change. So meaning example, macam example tadi dah saya letak, first until third year, katakan the G is 10%, and 4 years onwards, the growth rate is 15%. Okay, so we have two Gs. The first 3 years is 10%, the fourth year onwards, 15%. So for the first step, we're going to find the dividends until they change from 10 to 15 in year 4. Right? So we're going to find dividends until dividend number 4, till the year of the final G change. So our G change in year number 4. Okay, so they change once. Okay, the question boleh change the G multiple times juga. For example, katakanlah, I nak tambah it's not 4 onwards, just year number 4. Katakan year number 4 dia tukar 15, but year 5 onwards, dia ada 3 kali berubah. The G will change at 12%. Okay, first 3 years, 10%, and then fourth year, 15%, and fifth year onwards, 12%. So there are 3 changes here, ataupun twice the change. So if this is the case, you're going to find the price of, you're going to find the dividend until year number 5, because the final G changed in year 5. Okay, so that's our first step, to find dividends until the year of final G change. Okay, so case-to-case basis, question-to-question basis. Read the question carefully. Okay, step number 2, you're going to find the price. Okay, similarly, I akan tambah before the year of final G change. Okay, before the year. So meaning, if our dividend kita cari sampai year 5, so for the price, we're going to find the price before the final year. So meaning, kalau dividend until year 5, our price will be 1 year before that, which is year 4, P4. Okay, so find the price before the year of final G change, 1 year before that. Okay, so that's our second step. And lastly, once you have the dividends and also the price, we're going to discount it using the same formula. Okay, so let's do it one by one like this. Example number 5. A company expects its dividend to grow at 10% for the first 3 years. Okay, so 10% for the first 3 years. So meaning for year 1 until year 3, it will be 10%. And then it will be 12% 4 years onwards. 12%. So meaning our G, the final G happen in year 4. So kita akan pegang year 4 ni as our final G. Right? The last dividend paid, okay, this is the keyword. This is last dividend paid was 50 cents. So again, this is our D0. The same rule applies. Kalau dia guna, the expected dividend will be 50 cents, then we know that's D1. Okay, so we're going to start with D1. But in this case, they gave us 50 cents as the final dividend, ataupun the last dividend paid. So this is our D0. So for step number 1, we're going to start with D0. And the K is 10%, sorry, 18%. The required rate of return is 18%. So this is our K. So the question asks us to find the value of stock today, or in other words, they ask us to find P0. Okay, so for this, maybe I use one C page kat sini lah. Illustrate to you. Okay, bear with me. I'll be back and forth between the question and the answer. So we're gonna start with step 1. Okay. Again, recap step number 1. We're gonna find the dividends. Okay, until the year of the final G change. So in this case, the final year of the G change happened in year number 4. So technically, we're going to find dividend until dividend number 4, ataupun D4. And we're going to start with the information given in the question. And as I said, this question provides us with D0, which is 50 cents. So we're going to start with D0 lah, 50 cents. So we need to find until D4. Okay, so for D1, we're going to increase it Similarly, like this formula, we're going to find one by one until D4. We just ambil dividend, multiply with 1 plus G respectively, respective of the G of that particular year. So our first year, the dividend increased by 10%. Okay, 10%. So we're going to increase this by 10%. So 50 cents by 10%. It's going to be 55 cents. Okay, so D1 is 55 cents, and for second year, D2, this 55 cents will increase by another 10%. 0.61 or 61 cents. Okay, and for the third year, it will increase again by another 10%. 0.67. Okay, and make sure consistent, because the growth rate happened at 10% for the first 3 years, but for the fourth year, it will grow at 12%. Okay, so for the fourth year, for D4, it's not increased by 10%, but it will increase by 12%. Okay, the 12%. So here it's 75 cents. 75 cents. Okay, so this is our first step to find dividends until the year of the final G change, which is in this case, is year number 4. Okay, so that's our first step. Okay, find the amounts of dividends until the year of final G change. Now we're moving on to step number 2, to find the price. So the question asks us to find the price, which is the P. And the price must be before the final G change, ataupun before the the year of final G. So we define tadi our G change in year 4. So we find sampai D4. So for step number 2, we're going to find the price, okay, which is before year 4. So before year 4 meaning year 3. So we're going to find price for year 3. Okay, price for year 3. So which formula to use for step number 2, price year 3? So to find price year 3, we're going to use this formula, the one yang letak dalam bracket ni tadi. Dalam bracket lah, dalam box. Okay, we're going to use this formula, Pn with the n plus 1 divided by k minus g. So if the question asks us to find P3, so P3 means D3 plus 1, sama macam tadi lah, which is D4 k minus g. Okay, so if that's the case, P3, it will be D4 k minus g. So we know our D4 already. So from step number 1, we have D4, which is 75 cents. So we don't have to calculate. Just put 75 cents here. Because P3 is D4 k minus g. And the k from the question is 18%. This one. 18%. And the g, all right. So again, since multiple growth rates, we have multiple g's. We have 10 and we have 12. Okay, so which one to use in our formula for step number 2? For step number 2, the g that we're going to use the last one, the final g. Okay, so since we have two g's, 10 and 12, so the last one is 12 kan? So we're going to use 12 kat sini. So kalau macam ni tadi ada daripada 10, 15 and then drop to 12, we're going to use the last one. Okay, always use the last one. Macam ni tadi lah. So the first 3 years 10%, the last one is 12%, so we use the last one. So kalau dia berubah lagi, katakan 10, 12 and then 8, we're going to use the last one, 8. Contohnya. Okay, so here berapa? RM12.50. RM12.50. So now we have the dividends and also the price. So therefore, once we have these two information, we can prepare step 3, which is the discounting step to find the P0. Okay, and again, recap balik If we recap back to the formula, we're going to start with D1, not D0. We're going to start with D1, D2, and so on until the price. Okay, and remember the N must be consistent. N must be consistent. So kalau kita punya price 3, dividend 3. So kalau dividend 3, price 3, something like that. Okay, to the power of 3, to the power of 3 contohnya. Which is appear in step 2. Kalau kita tengok kat step 2, we have P3. So we know if the price is year 3, our dividend must be for 3 years only. Okay, so if you look closely to step number 1, we calculated until D4. Okay, until D4. But in step number 2, we're going to use until price 3 only. Okay, so don't make a mistake here. The reason why for step number 1 we have until D4. Okay, so technically if I draw a line here. Okay, so this step number 1 to find until D4, this D4 is only applicable or will be used once in step 2 ni je. 75 cent, we're going to use it once here. For step number 3, we just focus on the first 3 years but our step number 2 define price in year 3. So if you have price in year 3, so we're going to have 3 years of dividend only. Okay, so it will be 55 cents plus 61 cents plus 67 cents plus 12 ringgit and 50 cents. Okay, so we're going to have 3 years of dividend and 1 year of selling price. Okay, so technically this will be used in step 3. And this one will be used in step 2 only. And this 1250 will be used in step 3 as well. Okay, so if you don't want to get confused, you can draw a line from the step number 1. The final one, we're going to use only for step 2. The rest from D1 to D3, we're going to use in step 3. Okay, and our K, 1 plus K tadi, K berapa? K 18%. So 1.18 squared, 1.18 to the power of 3 is also 1.18 to the power of 3. So 55 cents plus 61 cents, 8 to the power of 2, 7, 8 to the power of 3, plus 3, 8 to the power of. So here, you're going to get 8 ringgit and 92 cents. Okay, so this is the intrinsic value based on this question. Okay, so we have 3 steps. Step number 1, I recap to find the dividends until the final G change. Reason why we have this 1 additional year is basically to support our step number 2 because step number 2 requires that information. Okay, so step number 2 to find the price before the final G change, right? And step number 3, we're going to discount the dividends, relevant dividends, and also the selling price. Okay, the key, tengok kat 3 ni So if price 3, we're going to use dividend year 3, and the power pun N, which is year 3. Okay, so this is the formula lah ataupun the steps. Okay, but I showed you the way how to do it. Okay, between the two ni, I use this one. I use this concept, meaning D1 is D0 multiplied with 1 plus G, and then the amount that we get from D1, we carry forward to calculate D2, which is D1 dot 1 plus G, and so on, just like what I did here. Okay, the D's in front here keep on increasing. But if you look at this model and the funny, they use all these zeros. Okay, but the power ni yang berubah. This is just like what we did here ni tadi. To find the price in the future. For dividends for the future dates. Okay, this is applicable, boleh pakai if you know how to use it. But if you tend to get confused, just focus on this method lah. Okay, this is faster if we have long years. Maknanya nak cari D3 instead of you find D1 and D2, you can straight away use this formula and then D4 macam ni. Then you kena change lah, maknanya kat sini kalau you nak guna step number 1, you can find D3 straight away by having descent 1.1 to the power of 3. You akan terus dapat 67 contohnya. And then baru D4. You gonna miss, but you need every time ni kan. So might as well I suggest you to use this one. Okay. Use one by one because you need every year's dividend to be part of your dividend for step number 3. Okay. So with that, I think that's the end of topic 7. The stock valuations. So we have two parts ataupun two types tadi. We have the preferred and also the common stocks. Maybe maybe within 5 minutes macam ni. Kita dah buat tadi for question number 1 and question number 2. Okay, obviously we'll not go through everything. Ada banyak kat sini, you can try on your own later on. But maybe you can check, okay, your understanding whether you can see the difference between the models. Okay, so for example, question number 3, suppose you plan to purchase a share that is expected to pay a dividend of 90 cents, 110 in year 2, 120 and 115 in year 4. And you plan to sell for 14 ringgit. So if your required rate of return is 50%, would you buy the stocks today if the price is 25 ringgit? So which model? This is model number 2, sorry, not 1. This is model number 2 in constant dividend. In constant dividend because the dividend is not fixed. It changes from 1 year to another. So this is in constant dividend with no growth rates. Okay, so in constant dividend meaning you just use the discount model lah. Okay, you're gonna use the discount models. Find P0, P1 plus K plus D2 1 plus K squared sampailah Pn 1 plus K to the power of N plus price N plus K to the power of N. So you're gonna use this formula for question number 3. So your D1 is 110, D2 120, 115, sorry, 90 cent D1, 110, D2, 120, D3, and 115 D4. So meaning you have 4 years of dividend with a selling price of 14 ringgit. Okay, and you try yourself, number 3. So question number 4, Kokora Berhad is paying its current annual. Okay, this is current annual dividend. So this is D0, 420. And the dividend is expected to grow indefinitely at a constant rate of 6%. So we only have one growth rate, 6%. Okay, automatically we know this is model number 3, constant growth model, because the growth rate is grow 1 time 6%. And this is the K. Okay, calculate the current market price of the stocks. So meaning the P0 lah. Okay, this is D0, 420. So it will be 420 times 1 plus G. G is 6%, 106, divided by the K is 13%. The growth rate is 6%. That's how you solve question number 4. Okay, I told you lah. 4.2 increased by 6%, divided by 7%. So you're gonna have 63 ringgit Okay, so that's question number 4. Okay, question number 5. Couple of minutes, tengok jap je. Abdul is considering purchasing common stock of Tiga Berhad. The company recently paid. Again, they use the word recently paid of RM2. So this is your D0. So the K is 10%. Compute the price if you should pay the stock if the dividend will constantly grow at 5%. Okay, so this is the growth rate. Again, this is model 3. Okay, nanti you try yourself. We dah define tadi. This is D0. This is K. This is G. Okay, so split dalam model. Question 6. Zaza Corporation paid dividend of RM3 last year. So again, the dividend RM3 paid ni is your D0 because it's already paid. The dividend are expected to grow at 5% for the next 3 years, and then will grow at 9% in the following year onwards. So you see, we have 5% G and 9% G. So this is model 4. Because we have more than one growth rates, 5% and then 9%. So automatically model number 4. So you're gonna prepare the 3 steps that I showed you earlier. Okay. The K is 15%. Okay, the K is 50%. So you need to find the dividend until the year number 4 juga. Sebab the 9% happen in year 4 onwards. So you need to find the dividend until year 4, the price until year 3, then you discount it, everything. Okay, just like my example tadi. Dalam ni example ni semua just paid, tak ada yang example yang expected to pay. Okay, ni just last one. Question number 8. This is again just paid. Okay, so this is D0, 60 cents. The company stocks are currently selling at RM12. So this is the market price, current price, RM12. If the dividend is expected to grow at 6.5%, so this is your G, 6.5%, and your K is 10%. Compute the price of the stock 3 years from now. So the question asks you to find P3. So kalau P3, we know it's D4. Okay. So you can try nanti lah. Any of these questions. So 1 and 2 I dah tunjuk. Question 4 pun ada answer. So you can try other question. Question 3, 5, 6, 7, 8. So on. All right, any questions? So we've done topic number 7. So we have plenty more to go. We have, in fact, 4 more topics to go. Ada risk and return, capital budgeting, making capital investment decisions, which is extension of capital budgeting, and lastly, cost of capital. Okay, cost of capital ni just like a long-term financing lah, long-term financing. So if there's no other questions, I think I'm going to stop here. Thank you very much for your time. As always, I will share the video once it's available. Okay, so thank you very much. And we will continue with the next topic next week. Okay, thank you very much.
Thank you.